Hey everyone, so if you're new to my channel, well, I'm glad you have found it. What I'm trying to do here on my channel is explain that investing in the stock market is more than just buying a company you love and that's it and thinking it's going to go to the moon. There are a lot of people who are going to get crushed by this mentality and I'm trying to help you avoid it. Maybe you're a little concerned that something doesn't feel right about all the hype around Bitcoin or Tesla. Well, you're not alone. My strategy is to look at an investment based on its financials, just like we would if we wanted to buy the entire company and run it ourselves. And today I'm going to do a quick high-level valuation of a company called Appen out of Australia to see whether it is worth spending some serious time researching it. Now, I'm not doing a full analysis here. I don't have the time to seriously analyze the thousands of companies out there. So I'm trying to filter as many of them out as I can using this method. And even if this company passes or fails this quick valuation, it doesn't make it a good or a bad investment. It's just a way to motivate me whether I want to go onwards and do further research and study the company in that serious detail. So just sit back and follow along to learn how to do this yourself. Plus, we will have a target buy price by the end of the video as well. It's part art and part science anyway, and the more practice that we do, the better we're going to get. Now, to analyze this company, what I'm going to do is I'm going to go through my 9-point checklist and then give you my opinion at the end. So the first thing we have to talk about quickly is, well, what is the company? What is Appen? Look, very basic research into this. I'm not going to waste too much time trying to dig in to work out exactly what's going on here. But I found out that, well, there's something to do with machine learning and AI stuff. It's based out of Australia. It's a small cap company, about 1.5 billion Australian dollars. But honestly, I have no idea what exactly they do. I'll deal with this if I get amazing metrics and an amazing price, then I'll go and deal with that later. All right, revenue growth. First thing we're going to look at. So I'm going to go and try to find the revenue growth. I'm going to use TIKR terminal. And here we go. We've got the revenues here. So we've gone from, looks like 111 million up to about 600 million over the past 5 years. That's definitely a tick. Great, we can move on. The gross margins, now I can find that here as well. And the gross margins have been, looks like they've been pretty stable actually. Started at 24%, still about 24%. The issue I have here is that that's quite low. So I'm normally looking for gross margins, maybe 30, 40% as a minimum. The bigger the gross margins, the better, the more money they're going to have to invest back into the company. And I don't like low gross margins. It doesn't give them much room for error and doesn't give them much room for new competition coming in. I'm not that happy with that actually, I'll be honest. So I'm going to give that a cross. Return on invested capital. Now, what I can do is here, I can look at the ratios here in TIKR terminal, and we've got return on capital, return on equity, return on assets, things like that. It looks like it's around about 10, 11%. Look, that's okay. Double digit return on equity and return on invested capital is okay. I'm really looking for above 15% here. I'm probably okay with it for the moment, but I'd like to see that higher. I think once they become more profitable, we will see that number increase, but it's on the fence at the moment. I'm going to give it a tick, but a reluctant tick. All right, debt. Now we want to see the current ratio. So I go to the balance sheet and I look at the total current assets for 2020 was 200 million was the current assets, and the current liabilities is only 77 million. So they've got definitely plenty of enough current assets to cover their current liabilities. Short-term debt issues are not a problem. Let's continue. Free cash flow. All right. Now, to find free cash flow, what I'm going to do is I go to the cash flow statement and I go down to cash from operations. Now, cash from operations isn't free cash flow exactly. We have to take out this capital expenditure number. But as you can see, I don't know what the change in net working capital is. I'd have to go and have a little bit of a deeper dig into working out what's going on here. But look, cash from operations, that's gone from 12, 13 million to nearly 100 million. But the capital expenditure has really stayed the same. That's fantastic. That's some really strong free cash flow growth. So yeah, I'm okay with that for the moment. Now let's talk about the brokerage accounts that you would need if you wanted to invest in this company. Now, because it's on the ASX, the Australian Stock Exchange, you're going to need a brokerage account that can handle international markets. Interactive Brokers and Saxo Bank can do both these things. They have access to many international markets. It's fantastic. Japan, lots of countries throughout Europe, Hong Kong, places like that. It's great. look, they have a stable, long history as well. So they've been around for multiple decades, not like Robinhood or anything like that that's just come around recently. That's really just essentially a startup. I think that risk is way too high. I prefer to have a very stable brokerage company. I feel like I'm already taking on enough risk investing in companies, the share market already, and the companies. I don't want added risk by having my brokerage account be in trouble at any point. And that's what you're doing with Robinhood. The fees for Interactive Brokers, I think, are the best across the board anyway. Very low fees. They've actually just scratched their monthly maintenance fee as well. So Interactive Brokers, links in my description. They are affiliate links, and I use both of these platforms. Now let's talk about shares outstanding. So shares outstanding is just the number of shares that are out there. Now, if this number is getting bigger, it means we're getting diluted, and that's a problem. If it's getting smaller, well, that means we're getting more value as an investor. That's fantastic, and that's what we want to see. So what I can do is I go into TIKR, and it looks like the total shares outstanding on the filing date. It goes back from 2018, it was 106 million, and it's slowly risen up to 122. So that's a problem. All right, shares outstanding is across. Now we look at insider ownership. Now what I do is I go into Simply Wall Street, and what I'm looking for here is I want the incentives of the management team lined up with me as a shareholder. That's really important. And it looks like whoever Christopher Von Willer is, the non-executive chairman, 12 years he's been at the company. I assume it's probably the founder maybe, but look, they pay him $200,000 a year, but he has $111 million worth of shares. That's some serious insider ownership amongst the board, a major board member here. So I'm actually pretty happy with that. That's not a problem at all. He is also the largest shareholder in total. So his incentives being on the board is very aligned with us as shareholders. That's great. Let's give that a tick. The next thing I want to look for is whether I can find any super investors already invested in this company. See, I'm not that smart. This is to help me get a little bit more conviction in the idea. If someone who's smarter than me, it's passed their filters and they've invested in the company, if they've done that, well, I would feel a lot better about investing as well. Couldn't find any of the famous gurus that I like, and I'll have to give this a cross. Okay, last but not least is price. Now, this is the most important thing. Nearly anything we invest in could be a good or a bad investment based on the price that we're going to pay. See, a great company that's overpriced, that's going to be a bad investment. Just like if you buy an iPhone for, I don't know, $1 million. That's stupid, and we don't want to do something like that with our investing either. It's a great product, the iPhone, but we're not paying $1 million for it, of course. So to do that, what I'm going to do is I'm going to use my intrinsic value calculator. It's free, it's in the description if you want a copy for yourself. So what I'm going to do first is I'm going to try to predict the next 5 years and then the 5 years after that of the growth rate of the company. It's really hard to do, and look, as we saw earlier with that revenue number, it has gone up dramatically, nearly 10x in 5 years. But if we go have a look at what the analysts think for the future growth, and I'm just here in Simply Wall Street, and we can see that the company's annual earnings growth is going to be about 17-18%. So I guess we can use that. I'd have to do some more digging to decide whether that was actually a good number or not, but let's use 18. Let's say it slows down to 15% after that, because it's just the further out we go, the harder it is to predict. Now, my return on investment goal, I'm going to put as 30%. Now, you might think that is crazy conservative and that's super high. I'm having a massive margin of safety here, and that's true. What I want from my investments is somewhere between 20, well, at least 20%. 20% plus is what I'm going for. So if I aim for 30%, even if I don't quite get 30%, I'm hopefully going to fall somewhere in the 20% range. If I had this down at 15% or 10%, as like a lot of other investors would do, I feel like I'm just not getting a big enough margin of safety. And it's just what I do, and you can do whatever number you want here. I like to use 30 because I feel like that gives me the best upside potential as well. The multiple I could sell it for, if it's growing at these rates, 18, 15%, I think I could sell it for 20 times free cash flow after 10 years at those growth rates. Now, we're going to go find the free cash flow number. Now, this was a little bit tricky, so I had to do it a little bit differently. And I went into Guru Focus and found the free cash flow per share of 0.536. Now, that's per share, 0.536. Now, I multiply that by the amount of shares outstanding. If I go back into TIKR terminal, I can find the shares outstanding here of 123.07. So multiply that by 123.07, and that should give us the free cash flow number of about 66 million. Great. So let's use 66 million as our free cash flow number. And the shares outstanding we just said was 123 million. Now, the last thing we have to do is find the cash and debt on their balance sheet. Here in Yahoo Finance, the total cash is 78 million, total debt is 25. So let's use those numbers now and get a buy price, 78, 25. And we have a price that I'd like to buy it at around about $6 according to these metrics. So let's go and now have a look at the actual price, and it is about $12. So we're not really there at the moment. I could play around with these numbers a little bit more. Maybe these growth rates are going to be a little bit more, I could be a bit more aggressive. Maybe I could say it's going to be 25% for the next 5 years. Maybe I don't quite want as high of a return on investment, maybe 26% is okay. I wouldn't like to go much lower than that because I want a margin of safety. And we're still only about $9 and the price is $12. So we're not really there yet. Okay, now for my overall opinion. Well, there's been good growth, but can it continue? The analysts think about 17%, so that's not the same growth as what we've seen so far. The gross margins, they're low as well. So look, the business is still quite inefficient. That ROIC has been declining. I'm not quite confident about that number either, but the balance sheet was really good. If we want about 15% returns, then look, this might be okay, but that wouldn't give us much margin of safety. So if I go back and have a look at what it would look like at 15%, well, look, that would be we need to buy it at about $19. So that's pretty good. Oh wait, I actually need to change the growth rates back down. So maybe 18%. There we go. 18% is about what we'd probably get now, but without any margin of safety, remember. So I guess if we want that 15% return, this might be okay. Now, the industry, AI, machine learning, it sounds pretty cool, but that's also where everyone else is competing. And for me, this is an easy pass. Doesn't make it a bad investment. If you do some work on this and do some research and understand really in depth about this company, maybe this is a massive opportunity, but on the surface of things, I'm happy to give this a pass right now. I really hope you've enjoyed this high-level analysis of this small cap Australian company. If you did enjoy the video and you want to see more, don't forget to subscribe before you go, and I'll see you in the next video.